In this video, I want to talk about the ins and outs of supply and demand trading, the best market conditions to trade in them, how to set up targets, entries, what to look out for, the magic or the non-magic behind supply and demand. Essentially, things you may not know of, I want to touch in this video to clear up a lot about supply and demand trading or just price and volume in general. Before we get into it, I recommend everybody to follow me on my Instagram at Ameritrade. This is my only account. The link will be in the description below. I post supply and demand zones, really good trading tips and tricks, and stuff you're just not going to find anywhere else on the internet. The link will be in the description below. You're missing out if you're not following me on there. But now let's get right into supply and demand. So the first thing I want you all to understand, because I would say this is a big misconception with supply and demand trading, is it's not just marking a bunch of boxes on your charts and taking the market long or short when we hit a box. There's a lot more to it. And the more you add to it, the better chances of success and the higher probability setups that you are going to take. Now, I'm going to show you some actual trading examples, but first I want to show you and give you this analogy of the tree. So how I use supply and demand is I view it as a core, or basically the tree trunk to the tree. Now, I use it at the solid foundation because supply and demand should be used in conjunction with other tools to give it a high probability of success. Without the core or supply and demand, it's not going to give me life in other branches or other aspects to trading. Now, other aspects are reading organic price action. We can do this with tools like Bookmap and reading real organic price action based off level 2 and time and sales data, understanding the auction place between buyers and sellers, who's aggressive, who's not aggressive, coming into the market. We can also do this with other tools, just like normal volume. Market context is very key. Any other order flow tool, you could talk about volume profile, market profile, footprint charts, delta. There are so many other aspects that could branch off this tree, but using supply and demand is the core to my strategy, and it's essentially what I look for, and I use other order flow tools to give me other aspects of life and other branches off this tree. So a common misconception is supply and demand in itself is very powerful, but when you add other aspects to your trading with organic price action, it makes it even better and more valid and reliable. So how I look at the market is a two-step equation. It's my where and when and why component gives me a valid reason to enter the trade. Supply and demand zones give me my where component. It's where I want to be present, and it gives me an area of interest in the market. These basically are advertising price saying, okay, if the market comes down to $100, this is a good deal, and this is going to offer a very good opportunity to buy or long the market once it comes down to $100. It's advertising that price is at a discount based off structure in the market. It's an area or a price of interest. And then we must use price and volume to give us our when and why component, which basically validates that trade and tells us that we should enter this setup because we see buyers and sellers at our area of interest. The simplest way to trade supply and demand, and what everybody is used to, is you long moves down into demand, where you take the market long expecting a bullish move to the upside, or when the market's inside of supply, you look to take the market short and you are expecting a sell-off from a supply zone. These are imbalances based off the chart in the past, where the origin location skewed the supply-demand equation, where this supply zone formed in the past, supply exceeded demand, and the market moved far away from that level in a fast and violent manner. And the same thing for the demand side. Where demand zones form is because an area back in the past, the demand exceeded the supply, and the market moved up in a very aggressive and violent manner. This was an example of a setup in the pre-market plan. I post these every single day in my Discord. Setups I'm watching, levels I'm looking out for, and potential trading scenarios. On the S&P 500 this day, I said I do not want to be bullish on rallies below 3876 supply, and then we also had demand / a target below at 3840. I said I first want to look for sellers here at 3876 supply for a sell-off back into 3840. So essentially what you want to do is, now that you have your levels of interest, you want to wait for the market to open up and trade at your levels of interest. Maybe you get valid confirmation here and you could take a quick little 15 to 20 point scalp to the downside. Maybe you wait for the double top to come in, aggressive selling pressure to hit the market. Then you take the market short, targeting the demand zone or maybe support below or any other tool that the market's giving you an area that it could potentially reverse at. We hit this 3840 level and then rallied back into the supply, eventually breaking above it. So again, these are areas of interest. Here's another good example on the NASDAQ. We had a zone at 11200, which is this green box, that we want to focus on playing longs here for a rally as there's minimal supply or minimal resistance above, targeting 11353 supply, which is the red box here. Market opens up, this area bounced off of it, large upper wicks. We found buyers at this zone. And as the market starts moving up, we realize we do not have any supply until 11353. The market rallied from demand and hit supply where we sold off from. Again, this is a perfect world. It doesn't work like this 10 out of 10, A plus every single time. I'm actually going to show you flaws of this strategy at the end of this video, but this would be a perfect example of finding buyers at demand and sellers at supply where the market reacts both ways. We must understand market conditions. This is vital. Not one condition is going to be identical to a previous condition. So it's important to understand and go with the trend of the market. You want to go with the flows of the market. So in an uptrending market where we put higher highs in and we put higher lows in, demand zones are going to work the best to play long at retracements inside of a demand zone. So let's just say this red line over here and this violent aggressive move to the upside formulated a demand zone in this area right here. The idea here now is to play the market when we retest in this zone because we are putting higher highs in and we are putting higher lows in. The immediate trend is an uptrend. Now here's a recent uptrend on the S&P 500, and as you could tell, we're putting in higher highs, we're also putting in higher lows. I could draw 100 different zones on this chart, but just to do it very, very fast, as you can see, dips down, get bought up, and everywhere we have a consolidation period forming a demand zone, the pullbacks on this uptrend get bought up, not only on a higher time frame, but also on a lower time frame. Now just flip the switch for a downtrending market. We're putting in lower lows. We're also putting in lower highs. Rallies or bounces to the upside should fail. Let's say a new supply zone does form. We look to take the market when it fails to rally up or a quick little pullback up fails. We look to take the market short when we come inside of supply and take profit at demand on downtrends instead of getting long. Again, conditions are very, very important. And here's a downtrend on the S&P 500 again. Rallies to the upside are getting sold into, forming new supply zones as the market moves down, and we take rallies or pops into these levels for the highest quality of setup depending on that trend that you are looking at. And it's very important now to distinguish the difference between a balanced market or an imbalanced or a trending market. When we are balanced, what's going to happen is it's best to buy the lows and the dips at the lows or the dips inside of demand, and then short the rallies inside of supply, because most of the time the rallies are going to be short-lived because the market is basically chopping or consolidating in a very tight range. This is when it's best to fade the extremes, short the highs, and buy the lows. In trending or downtrending markets, ideally you want to buy the retracements or short the relief bounces to the upside depending on the trend. Different market conditions bring different ways we can implement supply and demand, and in result, we have to adapt and change as the market changes in order to see efficient and consistent success. Now, I want to make it very clear that if the market bounced off demand every time or rejected supply every single time, we would have a market that essentially just moved sideways and had no direction or did not go anywhere. So the zones are not magic. You're not going to have zones that work out 100% of the time. It's not like we come into a supply zone and every time we hit it, I'm taking the market short. You need more clues than that. You need more factors, and there's more to it than just because we're coming into a pink zone that you take the market short, or if a market's coming into demand, you take it long. There needs to be more clues, because if we didn't have a zone here, right, you would not take the market short. And in this example, it did not work to the downside. And this is a good example of not only understanding that zones are not magic, but also understanding that we can use zones a little differently if we adapt to the conditions. So then what I do is I use zones as context to understand the auction and understand the responsibility or understand the mindset of other buyers and sellers. So I will use it as context, and this is a very, very good example. So on the S&P 500, this was in the pre-market plan. Scenario number one on the S&P 500 was I only wanted to be bullish and play long today if we can bid above 3888 to 3880, which is this pink box to the upside. If we can rally, get above this level, and it acts as support or new demand, I want to play long, targeting 3927, which was a target to the upside. So essentially, depending on the market conditions, now that you're aware of them, if the market is strong uptrending and truer higher prices want to be tested, then I want to gauge what the market does at, let's just say, a supply zone, because if we find acceptance at an area that once was a supply zone. Now keep in mind, what formulated the supply zone was a very strong reaction to the downside. So if the market comes back at some point in the future at this zone and we find acceptance, meaning buyers are accepting higher prices as the market moves up, especially inside of a supply zone in this case, then the chances of higher prices being tested are very, very high. So how can we use this as context is if new demand forms inside of the supply zone, aka do we consolidate? Do we find value at higher prices? Does the market indicate strong buying volume at the supply zone? And if that's the case, because this was once an already existing area where sellers stepped into the market, if we get a different reaction from market participants and buyers are willing to buy here, then we're going to look to play the market to the upside. Let's just say targeting the next supply zone to the upside, or maybe the next resistance level. So in this case is that if we can get above 3888, then I want to play long as it could act as support or new demand could get created above here, targeting 3927, but it still indicated that buyers were present here. Look at every single time we came into the supply zone and this 388 level, it acted as support. We formulated new demand, and then we got a strong buying volume breakout over here to the upside once we broke out of this range, indicating that buyers are accepting these higher prices, and that is your reason to get long, targeting the new supply zone above. So I don't want anybody just seeing a supply zone and saying, okay, we're in this level, let me take the market short. It also will give us very important clues about the market auction and participation between buyers and sellers. Now, here's another very good example about how to use context and how to use zones as targets. So on the S&P 500, we had a key area at 3867, 3875, which is this supply zone over here. Scenario number 2 was if we fail at this supply, I do expect the market to sell off and test what's out there below 3845, which is this red line. Below this level at 3845 opens the door to test 3805 again, which could be a very good downside target. So the scenario here is if we reject supply, then sellers are present in the market. Now, sometimes I might not short the supply zone because maybe we're in an uptrend and buyers are really strong. So what I first would like it to do is, let's just say, hit the supply zone, indicate sellers are there, let the market sell off, and then break structure or break support to the downside, in this case 3845. And if we can break 3845, that will indicate sellers are very strong, and then we can use the next demand zone below as a target to price. Again, it's putting the pieces to the puzzle together and gaining context of the market setups. So in this example, the market rallied inside of the supply zone, put in multiple lower highs. Again, this is all about using context, and this is not a setup that happened after the fact. This was a level that was posted 3 hours before the market even opened up, put in a bunch of higher lows inside of the supply zone, sold off, and then we got to this 3845 support level, which is this red line. This is when I took the market short. I did not take the market short at this supply zone, although it worked out very well. You could have very well did it, but the context did not fit this certain scenario at this exact moment. It would have offered a better risk to reward because we were getting in at the top of the move, but I was more comfortable waiting for this support level to break, because when it did break, I put my stop loss above this little high right here, and now I'm in short at 3845 with about a 7-point risk targeting this 3805 demand zone. And as soon as we broke below the support, indicated sellers very, very strong, sellers very heavy, and guess what happened? We had an all-day sell-off where every single rally into this 3845 level failed, and by end of day, we closed into this 3805 demand zone. This is a good example of using zones as targets. Sometimes you do not have to take the market long or short at a zone. That's very key. There are some markets, which I've been doing a lot recently, a lot actually, where I've been using zones as targets, getting long or short before that, and using the imbalances as targets rather than getting long or short at the zones themselves. And this is a very good example of that. This trade worked out perfectly. And as I mentioned earlier, it's not magic. It's very important to use other tools in conjunction with supply and demand to give you the highest amount of validity and reliability. So I don't want anybody, just because we come into a green box, to take it long or a red box to take it short. There are some times where the market does not react to any zones and they might be an invalid imbalance. And there's also some times where I think the strategy, the only con or the downside of it, is in trending markets. It's human nature to try to short, let's just say, an uptrending move. We short the move, it's short-lived. Maybe we could have capitalized on a few point move, but then we get caught and then the market wants to break the high even further. So I will say, in trending markets, sometimes we do not get retracements into demand. So in this case, the market did not pull back into demand all day long. Instead, we kept moving up, invalidating the supply zone, and it was very hard to get a long side entry. And if you did take the market short and was expecting a larger sell-off to the downside, it would not have been a winning day. So with every strategy, with every way to trade, there are flaws and there are cons. And I would say the only downside to supply and demand is in trending markets. Sometimes we do not get relief bounces that fail to the upside, and sometimes we do not get pullbacks into demand on uptrending markets. And that's the beauty of combining it with other tools, because it'll help you get setups that you may have missed if you use supply and demand in itself. So I'm going to end the video on that note. I hope you all enjoyed, got some value out of this. If you did, drop a like, comment any questions, and if you want to learn more, check out the links in the description below. I offer a very in-depth and educational course that also includes access to the Discord and no extra charge. But I'm ending the video on that note. Peace out.